So, you've heard about public market investors like hedge funds and mutual funds, but still have no idea how they operate on the inside. Let's take a look behind the curtain. If you haven't seen our intro to the World of Finance video, Buy Side versus Sell Side, we recommend watching it first, as this video builds on concepts explained in that video. Here, we'll focus on public market investors. Quick recap from the intro video. These funds both take in money from investors, with an aim of investing the money to generate profits over time. Let's now discuss what these funds invest in. Both of these investors can invest in a variety of securities ranging from units of ownership in a company, also known as equities or stocks, pieces of debt, also called loans and bonds, currencies, or FX, commodities, like oil or gold, and complex securities linked to the price movements of all of these items, called derivatives. We're going to keep this simple and focus on equity funds for now. Within the fund world, there are two broad strategies: fundamental and quantitative. Fundamental investing is driven by the underlying performance of a business and the resulting stock price movements. In contrast, quantitative funds employ formulas, aka algorithms, to invest, either based on pricing trends or company valuation data. We're going to focus on the most straightforward part of this world to begin with, which is fundamental funds that invest in equities. Let's dive in. To start with, mutual funds are referred to as long-only, whereas hedge funds are called long-short. We'll begin here with a look at mutual funds. But first, let's define what going long means. Going long is when an investor buys a stock with the aim of selling at a higher price in the future. When you go long, you buy the stock at a certain price, let's say $100, and aim to sell at a higher price in the future, let's say $150. When you sell, you collect the original investment plus a $50 profit or gain. Conversely, if the stock had declined to $50 per share when you sold, you would have incurred a $50 loss. This process is called going long. Because mutual funds typically only go long, they're called long-only. An equity mutual fund is an investment vehicle that takes in money from investors and buys and sells stocks with the aim of generating gains. In return for investing their money in various stocks, the investors typically pay a small percentage of the money invested, called a management fee, to the mutual fund manager. By contrast, hedge funds are called long-short because they engage in both long and short investment transactions. Let's look at what it means to short. Going short is the opposite of going long. When you go short, you're betting the stock price will go down over time. For example, if you go short at $100 and the stock declines in value to $50 when you exit, you generate a $50 profit. Conversely, if the stock had increased to $150 per share when you exited, you would have incurred a $50 loss. The mechanics behind shorting are beyond the scope of this discussion and will be covered in a later video. The term hedge fund comes about because these funds hedge out their long investments with their short investments. Let's look at how that works with a simple example. Investors give a fund manager money to invest. The fund manager then buys, i.e. goes long, 5 stocks and then simultaneously goes short the same 5 stocks. If the market goes up, the longs generate profits and the shorts generate losses. And if the market goes down, the longs generate losses and the shorts generate profits. As you can see, we've completely hedged out the ups and downs, also known as volatility, of the market. This clearly wouldn't be a great strategy though, because the longs and shorts cancel each other out. In real life, hedge funds typically invest in far more than just 5 securities. Also, they don't go long and short the same stocks. Instead, they go long stocks they believe are undervalued and short stocks they believe are overvalued. On average, as the market swings up and down, the overall portfolio will experience less volatility because the larger number of securities in the portfolio approximate the average of the market. But if the fund manager is right and the individual stocks revert to their true value over time, the fund manager generates a profit. The aim is to get the best of both worlds. You generate returns, but with limited volatility. Hedge fund managers also charge fees, but because the strategy is far more complex, they charge both an annual management fee and also collect a cut of the profits generated, which is called carried interest. Despite slightly different approaches, in the end, both hedge funds and mutual funds aim to take in money from investors and invest in securities to generate profits over time in return for a fee. So that's a brief look at how these funds operate. Hopefully, the terms hedge fund and mutual fund, as well as long only and long short, make a little more sense now.